All right, y'all. 2024 is in the rearview mirror. This is the very first episode of 2025. So today on Real Estate Backstage, I thought it would be fun for us to pull out the crystal ball and take a look at what is likely to happen in the housing market this year. Now, anytime we're talking about a forecast or a prediction, look, there are so many different variables to take into account, so many unknowns, exogenous events that could happen and derail everything. It is impossible to know for sure what's going to happen this year. But it is fun from time to time to take a look at what the quote-unquote experts are predicting. And every single year, a handful of organizations put out a forecast. National Association of Realtors, Mortgage Bankers Association, Fannie Mae, Goldman Sachs, HousingWire, etc. So I went through and I read a whole bunch of these various forecasts for this year. And I also went back and looked at what did these organizations predict would happen in 2024 and in 2023 to see who has a good track record of being pretty close to accurate in as many of these different data points as possible. And what I found is that the 2025 housing market forecast put out by HousingWire is probably the one that I would put the most stock in. This was a joint effort, I believe, between HousingWire and Altos Research. We've got Logan Motoshami over at HousingWire, and we've got Mike Simonson over at Altos Research. I think this, if you're going to read one of these, this is probably the one that you want to read. So I'm going to put the PDF up on the screen here for those of you watching on YouTube. You can get a link to this at realestatebackstage.com/episode 12. That's where we're going to put the show notes. And if you're listening to this right now on the audio-only version, like Apple, Spotify, do me a favor, go ahead and pull over on the side of the road, get your computer out, hop on YouTube. You're going to want to look at this for yourself. All right, so here's the PDF. And I went ahead and I highlighted some portions here. We don't have to read the whole 42-page report for this episode. All right, so let's start with the introduction. So this is from the HousingWire forecast for 2025. So, quote, as we enter 2025, the big questions looming over the real estate market are we finally going to see a housing market recovery? If so, how much and when? What about home prices? Should we expect them to crash? As we begin 2025, American homeowners have record levels of equity, home prices remain steady, and the country still faces crisis levels of unaffordability, especially for first-time homebuyers. As prices have stayed elevated, transaction volumes have not yet recovered. All right, HousingWire 2025 home price and home sales forecast. So this is what HousingWire expects to happen. Number one, home sales will grow in 2025 by 5%, resulting in 4.2 million existing home sales in 2025. Now, to put that in context, a couple years ago, we were at the 6 million transactions per year level. I believe in 2021, we were at about 6 million. And then by 2023, that got down to about 4 million. I think we ended up 3.9, just shy of 4 million. And then this year in 2024, we're probably going to be right. I say this year, last year in 2024, we're probably going to be, again, right at that 4 million mark. So they're expecting a 5% increase to about 4.2 million existing home sales in 2025. All right, next, home price appreciation will slow, but not turn negative. We anticipate approximately 3.5% home price appreciation for calendar year 2025. That has definitely been the trend. Home prices are still going up at a nationwide level. Obviously, this will vary from local market to local market. But overall, when you look at the National Association of Realtors, median price numbers, when you look at the Case-Shiller Home Price Index, the trend is that home prices are still going up, but the rate of increase has been decelerating. Next, inventory will grow again in 2025 by 13%, peaking in October with nearly 800,000 single-family homes unsold on the market, ending the year with around 720,000 homes in inventory. All right, so here are some of the core assumptions that they are factoring into their predictions. Number one, continued slight easing in mortgage rates to a range of 5.75 to 7.25%. Moderate economic growth with low probability of recession. Increased unemployment and less optimism on employment prospects. And the mortgage lock-in effect will slowly continue to lessen its grip on homeowners. All right, moving on. Let's see. All right, mortgage rate assumptions for 2025. Quote, the HousingWire forecast for home sales and home price appreciation forecasts assume that mortgage rates will stay in the 5.75 to 7.25 range for most of 2025. To stay in this range, economic growth in the country must remain positive, avoid recession, and not show signs of reinflation. Mortgage rates are most closely tied to the interest rate on the 10-year Treasury bond. Changes in economic trends drive the yield of the Treasury, which in turn drives mortgage rates. So basically what this means is that HousingWire is predicting we're going to see more of the same as we go into 2025. A lot of the same trends are going to continue. In the third quarter of 2024, the Federal Reserve began a rate cut cycle on short-term interest rates, assuming that inflation is under control and that rising unemployment is the greater risk to the American economy. The Fed's changes only indirectly impact mortgage rates. By October 2024, strong economic news, including strong employment data, drove a rise in the 10-year Treasury yield, which pushed mortgage rates back over 7%. So you can see in this graph here the range of mortgage rates during each year from 2012 through 2024, and then the forecast by HousingWire for where rates will be during 2025. Higher mortgage rates have recently impacted purchase applications for all of 2024, with slight improvements in September. In Q4 2024, mortgage rates were rising again, and mortgage applications to buy homes slipped back down. One lesson from 2024 is that homebuyer demand was stimulated as mortgage interest rates fell closer to 6%. So this graph here from the Mortgage Bankers Association shows weekly data points on the number of purchase mortgage applications. The light pink line there is from 2022. You can see over the course of the year, the number of applications decreased fairly steadily. And then in 2023, bit of a flat year. 2024, most of the year was below the levels the year prior until about mid-September. And then getting into October and November, we actually started to see several weeks in a row where the purchase mortgage applications were up over the year before. All right, quote, when mortgage rates reached 7.5% earlier in 2024, the index measured 14 weeks in a row with negative prints, 2 flat prints, and only 2 positive weekly data points. When mortgage rates slowly eased towards 6% in mid-June 2024, the index had 12 positive weeks, 5 negative, and 1 flat print. All right, so just as you would expect, when mortgage rates go up, that puts a damper on demand, and we start seeing fewer buyers apply for purchase mortgages. And then as rates go down, really toward 6% is where we start to see some really positive momentum. And we see a pretty good streak of positive data with an increase in purchase mortgage applications. All right, so this next chart shows the yield on the 10-year Treasury over the last couple years. And this is important because there is a relationship, there's a correlation between the yield on the 10-year Treasury bond and your average 30-year fixed rate mortgage. That is because a 30-year mortgage tends to have an effective duration of about 10 years. People are getting 30-year mortgages, but they're not actually taking 30 years to pay those mortgages off. They either sell or they refinance, typically every 10 years on average, which means a 30-year mortgage tends to behave like a 10-year bond, just in terms of duration, of how long it takes to actually pay that security off. Now, the 10-year yield and the 30-year mortgage rate, they don't move perfectly in sync with each other, but typically, if we see an upward movement in the yield on 10-year Treasuries, we're going to see upward movement in mortgage rates as well. And on the flip side, as the yield comes down on 10-year Treasury bonds, we're going to see mortgage rates come down. Now, just because the 10-year goes down today doesn't mean mortgage rates are going down today. They don't move perfectly in sync, but there is definitely a correlation between the two. A trend of declining rate spreads implies good news for mortgage rates heading into 2025. So this chart here shows the spread between the 10-year yield and the 30-year mortgage rate. So the light pink line here is 2022. You can see towards the beginning of 2022, the spread between the 10-year and the 30-year mortgage rate was a little bit north of 1.5%. Now, over the course of the year, you see that line go up. What that means is the spread between those two has gone up. So even if the yield on the 10-year stayed exactly the same, mortgage rates would have been increasing over this period of time because the risk premium or the spread on top of the 10-year was going up over the course of the year. So again, it started 2022 right around 1.5%, a little bit north of 1.5%, and it ended 2022 a little bit north of 2.5%. So there's a pretty dramatic increase in the spread there. Now look at 2023. So we started 2023 at about 2.75% spread between the 10-year yield and the 30-year mortgage rate. Looks like that was starting to come down until about March. So in March of 2023, something happened that caused that spread to jump up pretty significantly from about 2.5% to 3% in a pretty short period of time. Now that is when we saw the Silicon Valley Bank go under. That definitely caused some turmoil in the markets, and I think that is partly why spreads stayed higher longer than they otherwise would have. Now, throughout the rest of 2023, we saw the spread between the 10-year yield and the 30-year mortgage rate stay about the same, bouncing up and down here between 2.75 and 3%. And then in 2024 here, which is that dark red line, it started off the year about the same until late March, early April. And since then, we've seen that spread slowly come down. So as of right now, this is from November, this chart here from the Federal Reserve. As of right now, the spread between the 10-year and the 30-year is below 2.5%. All right, reading from the forecast, quote, the combination of the declining 10-year yield and declining spread makes for a relatively optimistic expectation for conditions in 2025. Notably, these were the same conditions generally expected at the start of 2024, and they took much longer to arrive than forecasters expected. As 2025 is set up for the same scenario, we expect them to lead to easier mortgage markets for consumers, but there is a reasonable chance that the economy again stays stronger for longer and rates don't improve much from here. So in order for rates to go down, we really are going to have to see some negative economic news. If the economy keeps humming along or even gets better, gets stronger, we could see the Fed reverse course. We could see inflation start to come back. We could see mortgage rates move upward. I think their range of 5.75 to 7.25 is pretty spot on. I really don't see rates getting below 5.75 unless there's some significant economic weakening. Significant risks of a market slowdown exist if mortgage rates stay above 6.5% for any significant portion of the year, especially in the first half of 2025. All right, so shifting gears over to inventory. The housing market of the last decade has been defined by consistently declining available supply of homes on the market. The inventory shortage reached a crescendo during the pandemic when Americans were buying everything available. Inventory has been building for nearly 3 years. In 2025, continued inventory growth may finally change the supply and demand balance back to old normal levels. All right, here we've got a chart of available inventory, available homes for sale in the U.S. over time, over the last 10 years or so. So starting in January of 2016, we can see the number of available homes on the market, and you can see that downward trend where every single year the bottom got lower, the top got lower. We can see that downward channel movement until 2018. Then it seemed almost like it had bottomed off and it was going to start increasing again. I remember I did a video back in 2019 before COVID talking about how the housing market may be kind of shifting slowly back towards a more balanced market. We had been in a what we at the time thought was a really strong seller's market for several years. And then COVID happened in early 2020, and just look at how inventory fell off a cliff. And over the last couple of years, though, it has been slowly recovering. Quote, inventory of unsold homes on the market will continue to rebalance over the next couple of years. Supply matters because it drives home prices and home sales levels. If supply grows big enough, home prices could start to decline. Now, look at where we are with supply. Right now, supply levels are 28% greater than this time last year, but we are still well below the historical pre-COVID levels of inventory. So I think inventory has a lot of room to grow before we have to worry about prices coming down. Inventory is a lot higher. Supply is a lot higher than it has been in 2020, 2021, 2022, 2023. However, we are still a ways below where we were in 2017, 2018, 2019. All right, this is the HousingWire projection of where the active inventory levels will be throughout the year. Quote, as the market slowly regains greater supply dynamics, that implies less competition among buyers for available homes. We may have fewer bidding wars, homes will take longer to sell, and there will be less upward pressure on home prices. This changing inventory dynamic also likely implies more transactions can take place in a year. So there is a really interesting relationship between supply and demand that is unique to the real estate industry. You really don't see this in other industries. And that is because many sellers are also buyers. So when something happens that impacts the demand side of the equation, that typically also impacts the supply side as well. So a great example of this is in 2022 when mortgage rates went up. Mortgage rates in 2022 went from about 3% to 7% within like a 6-month period of time. It was a big shock to the system. And this created what we call the lock-in effect. So if you think about all these homeowners out there that would like to move to a new home, but they would have to give up the 3% rate they have on their current home and then get a 7% rate on their next house. So all these people that want to move, they just decide it doesn't really make sense to move. When mortgage rates went up, that really put downward pressure on demand for housing. Now, typically what would happen when demand goes way down is you would see prices come down as well. But in this case, the same thing that impacted demand and caused demand to go down also pushed supply down because those people were not selling anymore. They were staying on the sidelines and not moving. These are people that would typically be buying and selling, all of a sudden aren't participating in the market at all. So we see demand go way down, but we also see supply go way down in 2022. And even though both supply and demand went down pretty significantly, demand was still higher than supply, which is why home prices continued to go up in 2022, 2023, 2024. And this is something that you typically wouldn't see in any other industry. This is why home prices tend to be very sticky. It's very hard, very rare for home prices to go down. Quote, there are indicators reporting above last year by several percentage points each week. None of the data is yet pointing to strong home sales in 2025, but it does show some growth. Given the stage in the cycle, we see 5% growth or 4.2 million transactions as the most likely scenario and 12.5% growth or 4.49 million home sales transactions as the optimistic case for the year. The downside case is roughly 0% growth in home sales over 2024. So HousingWire is expecting the number of transactions that happen to go up by about 5% this year. So that's a decent increase, but it's still a long way to go from the 6 million sales level that we saw a couple years ago. Over the last 2 decades, home sales have averaged about 5.15 million per year. During the years inflating the housing bubble, sales were as many as 7 million in 2005. In the years after the bubble burst and as the market slowly recovered, there were around 4 million sales until 2013. During the pandemic, that rate exceeded 6 million home sales in 2021. When we examine the ebb and flow of transaction volume in a given year, we can see the effect of policy incentive on home sales. After the housing bubble burst in 2007 and 2008, decimating total home sales volumes, government policy helped change the trend. In 2009, the federal government created a first-time homebuyer tax credit, which accelerated sales. 2009 saw 5% more sales than 2008. In 2010, however, when the credit expired, sales dipped again to 4.12 million. So this begs the question, how much can home sales recover in a year? Over the last 20 years, sales correction years tend to be more abrupt than recovery years. Corrections or market downturns hit hard and quickly, usually lasting 3 years. When the housing bubble burst, home sales fell by 8% in 2006, 23% in 2007, and 18% in 2008. When the pandemic boom ended, home sales fell by 18% in 2022 and 19% in 2023. Conversely, market expansion cycles last for as many as 10 years, with sales climbing slowly over time. In the recovery period of 2009 through 2019, home sales growth averaged only 2.7% per year. All right, so here's how I would explain this. Home sales are likely to take the stairs up and the elevator down. So in recovery years, the growth rate of transaction volume tends to be slow and it tends to take a while. But then when there's a correction or a downturn, it tends to happen pretty abruptly. We tend to see a pretty big decline, but it typically only lasts 2 or 3 years. All right, let's talk about the lock-in effect. So we have to counter any sales growth expectations with the knowledge of homeowners' ultra-low mortgage rates, what's been called the mortgage rate lock-in effect. The implication of the lock-in effect is that while falling interest rates will spur sales in 2025, the total growth in sales will remain capped for many years since so many Americans have dramatically cheap mortgage payments. As of July 2024, 75% of all mortgage holders in the country have mortgages with lower than 5% interest rates. This is such a favorable situation that many of these homes will be held for decades, keeping a lid on inventory and a cap on total home sales. So this is one of the reasons why I believe that homes are going to continue to go up in value. As long as I've been in the business, there have been people predicting a crash, that home values are going to go down, that we're in a bubble. That is not going to happen. We have such low inventory, and this mortgage lock-in effect is just going to exacerbate that issue. We could talk about the issue of how we haven't built enough new homes over the last 10 years, but this lock-in effect is definitely going to contribute to our inventory shortage for the long term, I believe. All right, here we have some data from the Federal Housing Finance Agency, and this is the percentage of outstanding mortgages by interest rate. So you can see the at the very bottom here, the light blue is the percentage of outstanding mortgages with a rate below 3%. Look at that. It's about 20%. So 1 in 5 mortgage holders has a rate below 3%, which means they either purchased or they refinanced in like late 2021 or early 2022. Now, how many of you, if you had a 2.9% interest rate, would sell and buy something new today at 7% unless you had a really compelling reason to do so? But this just goes to show how many people still have rates in the 3s and the 4s and the 5s. A very, very low percentage of outstanding mortgages are over 6% right now. In September 2024, the Federal Reserve began a rate-cutting cycle of short-term interest rates. At the time, the board's focus shifted from fighting inflation to protecting employment. Now, keep in mind, the Fed has what's called a dual mandate. They have 2 objectives. They want, quote unquote, full employment, which means they don't want a high employment rate, and they want low inflation. The target is to have inflation at around 2%. It is generally assumed that the Fed will continue this rate cutting cycle through the end of 2024. This was actually written before that final December rate cut from the Fed. If the employment numbers improve or inflation reflares with ongoing economic growth, the Fed could change course quickly. Current expectations have 2 25 basis point cuts in the Fed funds rate before the end of 2024 priced into the market. In this scenario, strong economic growth shifts bond market expectations for longer duration debt, which pushes interest rates higher on the 10-year bond and subsequently the 30-year mortgage. If the 30-year mortgage rate happens to stay near or above 7% in the first or second quarter of 2025, we expect we'll have to revise our forecast for home sales. Home buyer demand can stop abruptly. All right, now here we've got a handful of forecasts of the rate of home price appreciation in 2025. So for example, at the very top, we've got Goldman Sachs predicting a 4.4% increase in the price of homes. Wells Fargo just below them at 4.3%. HousingWire coming in at 3.5%. Pulsenomics at 3.2%. Fannie Mae at 3%. Morgan Stanley at 3%. MBA, Mortgage Bankers Association, 2.9%. Zelman and Associates, 2.3%. CoreLogic, 2.3%. Zillow, 2.3%. NAR is only expecting a 1.9% bump in housing prices. And Freddie Mac is only expecting 0.6%, with Moody's expecting 0.3%. Personally, I think we're going to be somewhere in the 3s. I think it's probably going to be somewhere between 3.5% and 4%. All right, baseline assumptions for home price appreciation. In the U.S., home prices increase most years by roughly 5%. This has been true for several important reasons. Number one, the U.S. has had reasonably consistent economic growth. Even in recession years, home prices have remained stable. Number two, the U.S. has a steadily growing population of adults of home buying age. All right, so speaking of demographics, I've got this other graph I want to put up here for you guys. This is from Pew Research Center, and this is the number of U.S. births per year, and they've even got it color-coded by generation. So I've got a blue arrow here on 1986. Now, what's the significance of 1986? Well, in 2024, the median age of a first-time homebuyer was 38 years old. The year before that, it was 35. The year before that, it was 32. So the average age of a first-time homebuyer has been slowly going up the last couple of years while we've been dealing with this unaffordability issue. So the average first-time homebuyer, 38 years old last year, means they were born in 1986. Now look at every other year after 1986. The number of U.S. births every other year on this chart was either the same or at a higher level. And this is just the new births. This does not account for net influx of population through immigration. So what this tells us is that we're going to have no shortage of new household formation, new buyers entering the market, becoming of age to become first-time home buyers, and creating additional demand. So you combine that with the lock-in effect of all these existing homeowners not wanting to sell. You combine that with the fact that we're not building enough houses over the last decade or so. And I think what this means is that there's going to be continued upward pressure on home prices for the foreseeable future. All right, so getting back to these baseline assumptions here for home price appreciation. Number 3, the U.S. economic, financial, legal, and tax policy at national and local levels are all designed to support home prices. This is very true. The United States is very real estate friendly. You ask anyone who's lived in another country how hard it is to purchase and finance, to sell real estate in other countries. We definitely have it a lot better here than we realize. Now, this is one of the things that NAR has actually done a pretty good job at. There's been a lot of negative talk about the National Association of Realtors recently. It's impossible to go on any of these real estate Facebook groups without seeing NAR getting thrown under the bus. And believe me, I am a big critic of NAR. I think there's a lot of things that they have done very poorly. There is a lot of change that needs to happen at NAR. But one of the things that they have done a really good job at is lobbying. They are actually the largest lobbying organization in the country. And they have done a great job of having conversations with our legislatures, at the national level and at the state level to promote policy that is favorable to the housing market. All right, reading from the forecast again, quote, economist Carl Case has described what's known as downside stickiness to home prices. This refers to the tendency of home prices to resist falling even when market conditions suggest they should decline. This phenomenon occurs because homeowners are often reluctant to sell their properties at prices lower than what they perceive as their home's value. When housing markets weaken, sellers tend to hold out for higher prices rather than accepting lower offers, keeping their homes off the market until they get their desired price, and exhibit loss aversion, being particularly resistant to selling at a loss from recent perceived levels. As a result of downside stickiness and these other factors, home prices have only declined in 5 of the last 80 years, 4 of which included the years the housing bubble burst between 2007 and 2011. All right, so this is what the folks over at HousingWire are expecting for the market in 2025, and I tend to agree with them. I think as long as we continue to see more of the same from the data, the leading indicators, then we're probably going to see mortgage rates slowly come down. I think we're going to see the number of home sales slowly go up. So as long as the labor market continues to weaken but not actually break, so by that I mean, the unemployment rate can inch up a little bit, the number of new jobs being created can continue to fall, the number of initial weekly jobless claims can tick up a little bit, but as long as we don't see initial claims get up in like the 320,000, 350,000 level, as long as we don't see GDP growth go negative, as long as inflation doesn't get out of control again. I don't think inflation even has to get all the way down to the 2% target this year, but as long as the inflation rate stays about the same or maybe goes up a tiny bit, down a tiny bit, I think if those trends continue, we're going to see mortgage rates slowly come down over the course of the year. If I had to put money on it and bet, I would say we're going to end 2025 with the average 30-year mortgage rate somewhere around 6.25%. I think we might bump up against that 6% threshold a couple times. I don't think we're going to get below it, and if we do, probably not for very long, unless there's some really significant weakening in the economic data. Of course, if that happens, then the Fed could become much more accommodating. They could loosen up policy significantly, which would probably bring mortgage rates down. But as long as the economy keeps doing what it's doing, I don't think mortgage rates are really going to get below 6% this year. On the flip side, if the economy overperforms, if things are better than expected, then mortgage rates could trend upward. So, if Trump gets in there and the economy really does well, like some people are expecting, we could see mortgage rates stay above 7% the whole year. All right, y'all, that's a wrap for today. Just a reminder, you can find the show notes with links to these resources at realestatebackstage.com/episode 12. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.